Welcome to Tycoons of Small Biz, a podcast designed for small business owners, the backbone of the American economy. Join us as our hosts Austin and Landon share insights and experiences as small business owners, active investors and operators who have started, bought, sold, and grown several successful businesses. Tycoons is powered by Backbone Planning Partners, a business consulting and wealth management firm built specifically to serve small and medium-sized businesses.
Good morning, Tycoons, and welcome to this special tax episode of Tycoons of Small Biz. I'm your host here, as always, Austin Peterson. Happened to be in our Las Vegas office today. Excited to be here and spending some time with Landon. We're going to get out and do some client stuff over the next couple of days, and actually do some client events with some clients. So we're excited about that. If you're tuning into this and just listening to it, I'd suggest that you go and look at this on YouTube, because what you don't know is that we have the best looking CPA in the entire world on the show today. We've got Max Getz coming in from Casey LeSueur Getz out of Mesa, Arizona. Max, welcome to the show.
Thank you. Did my mother write that intro for you? Because I think she's the only one who thinks I'm that handsome.
No.
Well, I appreciate it either way.
Yeah. No, that's all me. You know, I got to take the focus off of me by having a couple of good looking guys in the show with me. So
whatever works.
Landon, how are you, buddy?
Yeah, good morning. Doing great. And I will echo those comments. Yeah, every time we see Max, you know, he's just got the whole thing going on. The hair, you know, the perfectly trimmed beard, you know, the bright kind of stylish shirt, man. So Max, great to see you, brother.
Thanks, Landon. I appreciate it. Happy to be here.
All right. So we decided to put together this special tax episode. I think, you know, it's funny because Landon and I have been doing this for a long time. I've been doing it a little over, I think it's 24 years that I've been doing this. Landon about 14. Max, I know you've been doing this for a while, but, you know, Landon and I's role in our business is really, you know, strategy and financial planning with our clients who happen to be business owners. But we hear the tax word more often probably than any other word. You know, business owners just want to make sure that they're not paying more than they should. And so we thought, you know, we should put together a special episode specifically with a slant towards business owners to talk about some of the things that they should be thinking about, some things that they may know about, some things that they're not familiar with at all, some that they kind of know. And so we thought, you know what, let's have an expert on the show and talk about some of the things that he's seeing in his practice and obviously that we're seeing in our practice that would benefit the audience of Tycoons.
Yeah, I'm happy to be here. What I like about speaking with you guys is you're very focused on helping small business owners. That's one of the things that I love about the industry that I'm in. My focus is helping small business owners be successful by reducing one of their largest expenses in their lives, which is their taxes. So happy to be here. Happy to hopefully give the audience some good information, and excited to talk to you guys.
Yeah.
Landon, go ahead. You got something to say?
Yeah, absolutely. Appreciate it, Max. You know, as we were putting this, you know, together, one of you know, you're one of the first people that popped into our head for the sole reason, other than all the stats that we've shouted out about your great looks and your skill set, but you know, when we were thinking about, okay, who's like a really like forward-looking, proactive, like tax planning, you know, guru, and you were like, you know, the first one that kind of popped into our minds because, you know, we've got some clients that we work with, you know, together. We've sent a couple clients your way and gotten really, really great feedback, you know, and then of course experienced it ourselves, right? Because we've had multiple discussions with you with clients around proactive tax planning. So we know firsthand that you actually do it and you do it well. So just excited to kind of dig into that. But yeah, I mean, Max, maybe just give us kind of like a broad introduction as to like why is it important for small and medium-sized business owners to be having very proactive conversations with their tax professional. I mean, even this early in the year, even March, April, we've got a quarter or, a third of the year under our belt. So why is it important for business owners to be having these conversations with their tax professionals, even this early in the year?
Yeah, that's a great question. And what I would say about that, specifically with the topic of taxes, is there's so much good information out there online right now. But the problem with that information is it's very general, and it's not specific to the person that is consuming the information.
Mm-hmm.
And the thing about taxes is it is very specific to your situation. And so you can read some really good advice online or, wherever, and it might be really good advice for one person, but not necessarily for you. So that's where having a trusted advisor who is there to listen to you first. Like when I meet with a client, I'm first listening to see they're going to give me information about where they are currently and where they want to go and what they're interested in. And that's going to dictate the advice that I give them, because I can't take advice that I give to one client, walk into a meeting with another client, and know that that advice is going to be applicable or useful to them. And unfortunately, sometimes what's really good advice for maybe your friend is terrible advice for you because you're in a different circumstance. And then to take that one step further, I would say I may give you really good advice one year, but then your situation changes and that advice that was really good in the prior year is no longer applicable. So having that routine conversation where you're filling in your CPA on what's going on and where you want to go, that becomes extremely necessary. And then when we look at changing tax laws, again, the advice can change. So really working with somebody who's going to listen to you and is going to use the skills that they've developed through schooling and through practice and kind of have it. Honestly, it's a little bit of an art to be able to have a conversation with your client, with the taxpayer, see where they're at, and then use all of your experience and all of your training and say, I'm going to pull pieces of what I've learned that are applicable in this exact situation, and I'm going to give it to them so that at the end of the day, they can actually save real dollars and keep more of their money. So to answer your question, it's extremely important to meet with your CPA, multiple times a year. This time of year, we're really thinking about, okay, what has already happened and how are we going to report that? In the fall to the winter time, that's usually where we're looking ahead and we're saying, okay, what's happened throughout this year that we can use to plan for the last months of the year, so that when it comes time to do your taxes, we've made decisions before the end of the year to set us up for success when it comes time to actually file those tax returns. So it's not a one conversation a year. It's usually at least two. It's planning towards, middle to end of the year, or it's, okay, the year's over. Now, how are we going to take what's happened and put it on a tax return? And so, just developing a relationship to where the CPA gets to know you a little bit, has some understanding of where you are and where you want to go, that is extremely beneficial, because that kind of takes you out of that situation where you're reading advice or you're hearing advice and you're saying, this sounds great, but is it applicable to me? And that's the biggest question, is always, is it applicable to you? So you need a CPA that can kind of understand you and understand your situation before you start taking their advice.
Yeah, I think, Max, that another thing to kind of be aware of, even if you're just choosing somebody to use to help you with your taxes as a business owner, you want to know that CPA specializes in working with business owners, right? And is staying on top of all of their continuing education, right? Like, I know that you've got to do your hours, but the question is, are you choosing to educate yourself in specific topics that are going to be relevant to the type of clients that you work with, right? I mentioned at the top of the show, I've been doing this for 24 years, and I could tell you story after story of clients who say, my CPA gave me this advice, and I'm thinking, what? Why? That doesn't even make any sense for your situation, or your CPA doesn't understand what that is. They're not keeping up with the education specific to that type of clientele. So, I think that's number one. To kind of get into an actual topic that I hear all the time. I'll start with a phrase that Landon and I use with clients all the time, and that is, don't let the tax tail wag the dog.
Yeah. Yep.
If I had a dollar for every time I've had a business owner tell me, yeah, we're going to go out and buy this piece of equipment that costs $100,000 in November because our CPA told us that it'll help us to be able to depreciate that and save on taxes, and we'll be able to do this. And in a lot of instances, it absolutely makes sense. But if you do not need that piece of equipment, why are we spending that money just to save on taxes?
Yeah, absolutely. I mean, what I will tell clients frequently is, I want you to pay tax because I want you to be very successful in your business. I just want you to pay tax efficiently, meaning I want you to go out and make, a really nice income for yourself that you can be comfortable living on. And then the next step is, let's do that in a very tax efficient manner. So at the end of the year, I have a general idea, or the business owner has a general idea of where their income's going to end up, and they can relay that on to me. And I can kind of tell them, hey, at the rate you're going, you're going to be in this tax bracket and you're going to owe this amount of taxes. And then at that point, we can say, is there anything that you can invest in that will benefit your business? And if you do that, this will be the tax implications of it. Now, that's not to say, hey, you did really well this year, go buy yourself that truck because you're going to pay a lot in taxes if you don't. That's to say, if you were going to buy a truck anyways, you may want to consider doing it before the year ends, because it's going to be more beneficial to you than if you wait till January 1st, or the opposite. Maybe for one reason or another, the income isn't as high as it typically is. I might say, hey, hold off on buying that truck or that asset or whatever it is. Hold off until January. And then most likely the following year, you're going to be in a higher tax bracket because historically you've been in higher tax brackets. So let's take the deductions in the years where we know you're going to be in a high tax bracket. So just kind of understanding when is the right time to make those purchases and when is the time to hold off on them.
Yeah, Max, it made me, I wanted to kind of potentially close out with this, but just since you mentioned it now, maybe we'll just we'll peel maybe a layer back. And that's around how doing something like that can affect the enterprise value of your company if you are, selling your company in, let's say, the next 1 to 3 years, right? So I like that example of, a business owner gets to the end of the year, maybe they have a conversation with their CPA, or maybe they just go off their gut because they kind of know where they're at. And, a lot of business owners kind of operate that way, as I'm sure you're aware.
Mm-hmm.
And so they do go out and they make a purchase because they know that they're about to get slammed with a massive tax bill, come Q1 of the following year. Mm-hmm. So they go out and they make this big purchase that they probably don't really need to make,
mm-hmm.
But they go out and do it. And then let's say the following year, they get approached by, Sally Smith competitor down the road to potentially buy out their business. Mm-hmm. And now they say, yeah, let's explore this. And so they provide them with all their financials and their tax returns and stuff. And now this owner is going to make an argument that, oh, well, I didn't really need to do that. So I'm going to add that $100,000 or $200,000 or $300,000 purchase. I'm going to add that back to the profit for that year because I didn't really need to make that. So yeah. I don't know. How do you respond to that?
Yeah, no, that's a great point. And that's another thing that you would be talking with your CPA about and informing them, because if you are looking to exit your business in the next few years, you shouldn't be focused on lowering your taxes by increasing your expenses, right? Because that's just going to make your financials look less appealing to a potential buyer. So just letting your CPA know, like, hey, my end goal is to sell this in the next handful of years. That's going to change the advice that you get. Whereas if you come in and you say, hey, I love my business, I want to operate it for the next 20 years and it's very profitable, that's where maybe we'd say, well, let's look at some potential deductions that could benefit you. But yeah, to your point, Landon, if you're trying to sell your business, you want it to look very profitable. You want it to look extremely successful to the potential buyer. And you're not going to do that if your main focus is lowering your income taxes, because effectively what you're doing is you're lowering your income to get your taxes down. And that's just not the type of business that I would want to buy if I were a buyer. I want to buy successful businesses. And one thing that I will say quite a bit is when a business owner is really successful and we've done everything we can to make sure they're taxed efficiently, if they're still writing large checks for their taxes, I call those champagne problems, meaning it's a good problem to have. If you have to pay a lot of tax because you're wildly successful in your business, you're not going to get a ton of sympathy from me, because I'm actually excited for you that you won in your business. I know it. Trust me, I don't love being the person that tells people they owe a lot of money, but at the end of the day, we all want to be successful in our business. And one of the outcomes of being successful is frequently having to write a nice check to the government. And so as long as your CPA kind of prepares you for that and kind of says like, hey, you're doing really well, let's set aside money for taxes, or hey, we did this tax projection at the end of the year, it looks like you're going to owe this amount of money. If they give you that heads up, the CPA's done their job, assuming they have you in the right vehicle and you are being taxed efficiently. But if they're giving you the heads up, like you've done really well, you're going to pay taxes on this money, that's probably a good CPA.
Yeah, no doubt about it. I mean, Max, I would even go as far as to argue that like meeting with your CPA biannually to do these tax projections and tax planning, I mean, I would argue that that is probably one of the most important thing, like definitely the top 3 most important thing that a small business owner can do. Because as the 3 of us know here, and most people know listening, is that the number one reason that small businesses fold or go under or have to file bankruptcy or close the doors or whatever you want to call it is just essentially due to poor, cash management, right? Mm-hmm. Is they just don't do proactive planning around taxes and cash flow, revenue in, expenses out. And so they get themselves in financial trouble. And that's the number one killer, of small businesses. So I would argue that every single small business owner should be doing it. Mm-hmm. And if a small business owner is listening right now and they're like, yeah, great. Like, I've never had a tax planning conversation with my CPA because, I know what they charge, or that, they got some silly, excuse as to why they don't do it. Maybe they say that their CPA's never offered it, that could be true. But Max, for just generally speaking, if a small business owner wants to come in and meet with a high quality CPA like yourself for, I don't know, a 60 to 90 minute biannual tax planning session, like what would they expect to pay for something like that?
That's a good question. I would say the way that I do my pricing is I'll review the taxpayer's situation. I'll look through their prior returns, and I'll first put together a plan for them as to what I would recommend doing. And then at that point, I will tell them exactly what it's going to cost to operate that plan. Beyond that, I think it's part of my job to coach them throughout the year when they have questions. So if I've quoted you and if I'm your tax accountant and I'm going to do the tax returns and you're going to pay me for those, I want to talk to you. So I'm not going to charge you separately for that. That's included in the price of your tax returns, because I want whatever tax plan I put together for you, I want it to be executed properly. That is something that I see too often, where somebody might have a good tax plan or just accounting system in general, that they have a good plan for it, but it's executed poorly. And so that's kind of where, when you talk about excuses of like the cost of a CPA. Yes, CPAs are expensive. Having a bad tax preparer is more expensive 90% of the time. So for me, I can look through my clients and I can say like, maybe this year I didn't pay for myself, but on average over the course of 5 years, I'm going to pay for myself 3 times over just in tax savings. And usually when I meet with a business owner, if they haven't had a good prior CPA, I can usually get them into a system that allows them to save significant tax dollars year after year without them having to even think about it. We don't have to go look for trucks. We don't have to go look for deductions. We set you up on a good system where you're taxed efficiently, you're in the right entity type for what you're doing. And then hopefully you also have a nice accounting system that is going to just automatically track your deductions throughout the year so that when it comes time to file, you're not trying to think back like, oh, I know I spent all this money. We know you spent that money because we have your accounting records right here and we trust them because they've been updated monthly. So for me, it's when you talk about the cost of a CPA, a good CPA pays for themselves. A bad tax preparer will never pay for themselves. They'll cost you more than you pay them in actual fees. So, and I can tell horror stories about that. But the idea is, I generally tell people, if you're with a tax preparer that you wouldn't trust when it comes time to sell your business or exit your business, you need to get away from them as soon as possible. You need to be working long-term with the CPA that you would want in your corner when it comes time to sell. Because unfortunately, there are times where I'll take on a new client right before they're about to sell or they've already sold, and I'm handcuffed by the situation that their prior accountant put them in. So working with somebody that you can trust when things become complex is extremely important.
Yeah, I believe that 100%. And I would even add to that, Max, I've mentioned something similar to this on a prior episode, that the importance of having not only a CPA that you can trust and that is doing good work for you in your current situation and what your future situation is going to hold, but having them as a member of your overall financial team. Right.
Absolutely.
And so if a financial advisor that you're working with is not collaborating with your CPA, or your CPA is not willing to collaborate with your financial advisor, one or both of them should be replaced. The reality is those two individuals go hand in hand with you, and I would argue are the most important advisors that you have. And they hold each other accountable a little bit, right? Like Max may recommend something for one of our clients and we say, okay, I get that from a tax perspective, but did you factor this in? Right. And for the long-term enterprise value or whatever the case may be. And those two, I don't want to say opposing, but those two different viewpoints on things coming together to come up with the best solution for the client is where magic really happens for the business owner.
Yeah, I couldn't agree more, because what I will often see is there's so many solutions out there when it comes to like building wealth or reducing taxes, but for them to work perfectly, a lot of things need to align. And if you only see one part of the picture, you might say, well, this is the perfect account for them. But then when the financial advisor, the client, and the CPA meet together and we see the entire context of the situation, then you can start to say, well, that account that I thought would be perfect actually has these drawbacks. This other account is more closely, it resembles what the client needs closer than this account that I originally thought. And there's so many accounts, or there's so many solutions. If you just think of like retirement planning, how many types of retirement accounts are there? There's probably 15, and each of them have their own tax attributes, as well as things that they can be invested in, right? And so you think, if I talk to the financial advisor, he might send me this direction. And then if I talk to a CPA, he might send me that direction. Well, wouldn't it be better if we all just met at the same time and we could kind of just talk about the situation? That's generally where the best solution comes from, is when everyone is on a call similar to this, right? Where we're giving input, and I'm giving input on the taxes and you're giving input on the investments, and the client can listen and decide what they're comfortable with.
Yeah, agreed. All right. So we've talked about one or two strategies. We definitely talked about depreciation. I feel like most business owners kind of know that. I feel like that's the CPA's go-to. You know what I'm saying? Like,
Yeah.
well, let's buy
Yeah.
this. We'll depreciate it. It'll save a
Yeah.
bunch in taxes. Let's do this. But let's talk about some different strategies. You know, let's think about a business owner who owns their building, right?
Okay. Yep.
So the term cost segregation study comes to mind for me. So talk a little bit about a cost segregation study and how that may be beneficial to specific owners who own their real estate.
Yeah, that's a great question. So, you know, in the US, real estate has always been touted as this very, very excellent tax efficient investment. And that's true. There is a lot of good attributes to real estate for tax purposes. But there's often misconceptions with it. And so in this case, you have a business owner who buys their own business. Well, the main benefit from a tax perspective to real estate is you can actually depreciate it, even though generally speaking, real estate goes up in value. Well, the IRS code says that you can depreciate it. And if it's a commercial building, you can depreciate it over 39 years. Well, 39 years is a very long time. And we want to recoup those deductible expenses that we put into the building in the purchase price. We want to recoup that much quicker. So that's where a cost segregation study comes in. A cost segregation study is performed by an engineer. They go in and they say, well, these components of the building, they're not going to be around for 39 years. These should be moved into shorter class lives. And those shorter class lives, whether it's a 5-year class or a 7-year class or a 15-year class, those get depreciated much quicker, meaning you get to deduct that depreciation earlier. In some cases, you can depreciate some of those class lives in the first year. So you get this very large deduction. And that can be, depending on the situation, that can be immediately beneficial to the taxpayer, or maybe not. Maybe they need to, maybe they're not allowed to deduct it all up front. That's where having an engineer who can separate out the cost and then a CPA who actually cares what's going to show up on the tax return, working together to say to the client, hey, this is an excellent opportunity for you to get immediate tax benefit or sooner tax benefit from this extremely large purchase that you just made. And what I always think about is, again, it goes back to the tax advice is only good if it's very specific to your situation. And so having a CPA who can tell you, hey, this cost segregation study will benefit you, that is extremely valuable. Or having a CPA who is going to say, cost segregation studies are great for the right people. Unfortunately, you're not in the right situation for it. So, and real estate it's used for different things. So there's a very wide spectrum of real estate investing. But if you are a real estate investor, whether that's for your own business or that's you're wanting to passively rent out real estate and you're going to be the owner of it, those are two very different things. So having a CPA dig into it and kind of tell you this will be the impact on your tax return, highly valuable. Because you know, if you're a taxpayer and you go directly to a cost segregation company, you know, 99% of the time they're going to say, yeah, cost segregation study is perfect for you. Me and my partners, we joined up with an engineer to offer this service. And what's different about us is we see the ending of it. We see where that cost segregation is going to end up on the tax return. And I will actively tell a client or a taxpayer, I will tell them, hey, unfortunately, this isn't going to benefit you. I don't want you wasting your money on a cost segregation study that's not going to benefit you. I don't think a company that is strictly in the business of doing cost segregation studies, I don't think they're going to give that advice to the client. I think they're going to push to make the sale. And what I have found is if you do the right thing and if you have the client's best interest in mind, maybe you don't get every sale, but you get enough of them, and then your reputation gets to a point where there's plenty of work for you. So my advice is to somebody who's looking into investing in real estate, definitely look into cost segregation studies, but do it do it with a trusted advisor. Maybe it's Austin and Landon. Just talk to them and just say, hey, I'm thinking about doing this cost segregation study. The company who would do it for me, they're actively trying to get me to do it. Do you think it's a good idea? Or Austin and Landon may come to me. They may ask me my opinion on it, and I look at it, from the CPA's lens, where I say, yeah, we want that depreciation expense immediately because you're in a high tax bracket and you can take the deduction. We want it now. Or I say, all of this real estate is going to be passive. You're not going to be able to deduct that in the first years anyways. Don't waste your money on the cost segregation study.
Yeah, that's awesome, Max. And in fact, we've done that exact thing with a client where we send them over to you to look at this through a comprehensive lens. And so we definitely appreciate that. So in the spirit of having, call it, 3, 4, 5 minutes max left of our conversation, let's just kind of continue to burrow down this rabbit hole just a little bit more. So the cost segregation study essentially allows somebody to take the 39-year depreciation and to compress that down on some or the majority of the assets that comprise commercial real estate, and then ultimately take a bigger tax deduction on the front end, as opposed to having to wait 39 years and take a little teeny sliver of it every year.
Yeah, exactly. It's basically saying you bought that building for $1 million, instead of depreciating it 1/39th for 39 years. Let's look at that $1 million and let's say these components of the building, they're not going to be here for 39 years. Let's put them in the 5-year class, because that's what the engineer who is qualified to make that judgment call will tell us. And then, okay, you can depreciate it for 5 years, or it may qualify for bonus depreciation where you get a portion of it all in the first year. Currently, you can take for 2023, you can take 80% bonus, meaning you buy an asset for $100,000, you can depreciate 80,000 of it in the first year if it qualifies for that category. So that allows these very expensive real estate purchases to give you this immediate tax benefit, as opposed to waiting the 39 years, because we all understand the time value of money. I would rather save 100 grand in taxes this year versus 1/39th of that over the next 39 years. Put that money to work, right, instead of giving it to the government.
Yeah, no doubt about it. Yeah, well, a perfect segue. Let's spend at least a minute or two here of the last couple we have, and so let's continue to pull on that thread. So now a business owner, they've had this building, they've done a cost segregation study, they've held it for 5, 10, 15 years. Now they want to divest of that asset. So we're actually helping a client go through a pretty complex divestiture right now, which is they're selling a commercial building that they've owned for 25 years, I believe. So it's appreciated significantly in value. They've got a loss carry forward of a couple $1 million. They're selling the business for they're selling the building for just under 10 million. They got a $3 million loss carry forward, but they want to defer the vast majority of the taxes that are due on this asset sale. So we're talking about doing 1031s into some DSTs, Delaware statutory trusts, to potentially kind of kick that tax can down the road. So let's just spend a minute and talk about, like, at the very high level, Max, what is a 1031 exchange and how does that kind of work from a tax standpoint?
Yeah. So in this situation, you're looking at recognizing a very large capital gains. And, when you talk about that, that capital gains could be close to $7 million, what you're talking about right there, which is a lot of money in taxes, obviously. So a couple of options come to mind. There's the 1031 exchange. So a 1031 exchange is great for a taxpayer who is selling their piece of real estate and they enjoy being real estate owners and they don't mind investing into another piece of real estate. And if they do that properly, they can defer the tax on that capital gain for as long as they own that next property. There's a lot of details in that I've skimmed over, obviously, because we have a couple minutes. But I would say if that's something you're interested in doing, you first get your qualified intermediary, which is going to facilitate the transaction. They'll inform you of all the specific dates. And then just keep in mind, if you get any cash out of that deal because the property that you're replacing it with is less expensive, you're going to pay tax on that cash you get out. Mm-hmm. If your liabilities, your mortgage go down, you're going to pay tax on that. And then when you eventually sell that replacement property, you're going to have a very large capital gains, because basically all the capital gains you deferred are going to carry forward till you sell it. Now, if you're going to own that property for the rest of your life, the people who inherit it, they're going to get a step up in basis, and they're going to probably not pay any tax on that, assuming current tax laws stay the same. The other thing that is new, and by new, I mean since 2018, are these qualified opportunity zone funds. Mm-hmm. These are a really interesting tool. It's probably one of the, Austin, you talk about CPE and staying up on tax law changes. This is one of those really interesting new topics or new opportunities for taxpayers who have a capital gain. If you have this capital gain and you don't want to pay the tax on it, which nobody does, you have this opportunity to invest the amount of the capital gain into a qualified opportunity zone fund. And if you do that, you can defer the gain. So you don't pay the tax on the gain the first year when you have the capital gains. You hold it for 5 years, and the taxable gain goes down by 10%. So your basis goes up 10%. If you sell it after 5 years, you pay a little bit less in tax. You keep it for 7 years, you can exclude another 5%. So you're at 15%. That's great. But where it's really good is if you hold that fund for 10 years, you basically get your basis stepped all the way up to the fair market value of the investment. Meaning, if you hold that fund for 10 years, and you sell it in 10 years, whatever you sell it for, that's your new basis. So you don't pay any capital gains. So you're not just deferring the tax like you are with a 1031 exchange, you're actually avoiding it completely. So that's a really good strategy for somebody who doesn't need the cash right away, because you're reinvesting it into this opportunity zone, and somebody who is in a high tax bracket. So these strategies are fantastic when you're in a high tax bracket. Obviously, this client who is selling for $10 million is going to be in a high tax bracket on the gain alone, let alone any other income they may have. But if you're going to sell a property and you have a capital gains on it, but maybe it's a down year in your business, or your income isn't there that year, why would you want to defer the gains? You'd rather recognize and pay it in the year where your income's low. So having that CPA who kind of says to you, hey, this 1031 exchange is a great strategy for some people, but not for you in this particular year. So it's just having this mindset of, we are going to analyze the tax opportunities that are there, but we're going to analyze it through the lens of what has occurred in your financial life this year and where you want to go. So taxes, unfortunately, are very specific. So you need somebody who is going to listen to you and understand your specific situation. So there are opportunities out there. They're not going to suit everyone, but there's options. And sometimes the best option is just saying, we're going to bite the bullet and we're going to pay the tax on that capital gains, because I know I'm in a low tax rate this year, and half of it's going to be taxed at 0% anyways. And sometimes the answer is, I like being a real estate investor. I'm going to reinvest, so I might as well do a 1031 exchange. So talk to somebody who understands where you are and where you want to go.
Yeah, I appreciate that, Max. Just want to clarify real quick on the QOZ. You said something that wasn't 100% accurate. The deferral of the gain on the original transaction, that gain is actually just deferred. The 10-year hold allows the gain above, that new investment that you purchased. Everything that new investment gains becomes tax-free, much like a Roth IRA.
I believe the entire gain is deferred. We may have to agree to disagree on this one. I think your basis in the investment steps up to the current fair market value at that date, and so your basis would be the same as your proceeds. I could be wrong, but I believe that's how it works.
Yeah, the basis may step up, but I do know that the taxes on the original gain are due at this point on the tax law in just a few years. So that gain is that the taxes on that gain are just deferred for a little bit. But anyhow, we'll put some information in the show notes. You can obviously reach out to any of us at any time, and we can clarify that for you if qualified opportunity zone sounds like a good opportunity for you.
Sounds good. Yep.
Awesome. Max, that was fantastic, man. Thank you so much for making some time for us during your busy season. So appreciate all your insights here, Max.
Always happy to jump on. Love talking to you guys, and enjoy the rest of your day.
Likewise, man. Thank you.
All right. Take care.
Go Red Sox.
You've been listening to Tycoons of Small Biz, a podcast for small business owners by small business owners. Be sure to follow us on our social media channels for links to all our episodes and great content around growing, investing in, buying, and selling small businesses. This podcast is distributed for informational purposes only. Statements made in the podcast are not to be construed as personalized investment or financial planning advice, may not be suitable for everyone, and should not be considered as solicitation to engage in any particular investing or planning strategy. Listeners should conduct their own review and exercise judgment, or consult with their professional financial advisor to see how the information contained in this podcast may apply to their own individual circumstances. All investing involves risk of loss, including the possible loss of principal. Past performance does not guarantee future results, and nothing in this podcast should be construed as a guarantee of any specific outcome or profit. All market indices discussed are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested into directly. Investment advisory services offered by Backbone Planning Partners, LLC. Neither Backbone Planning Partners, LLC, nor its representatives provide legal or accounting advice. The content of this podcast represents the views and opinions of Austin Peterson and Landon Mance, and/or the podcast guest, and do not necessarily represent the views or opinions of Backbone Planning Partners, LLC. Statements made in this podcast are subject to change without notice. Neither Backbone Planning Partners, LLC, nor its representatives, the podcast host, or its guests have an obligation to provide revised statements in the event of changed circumstances.